Hello everyone and welcome back to the Cedi investor. I got a couple of comments from you guys and they were asking me to make a video giving my step-by-step analysis on how I do my research, especially when I want to invest in a particular company. Now, one thing I always tell people is that research when it comes to stock investing is very important. It's very key because imagine you are putting your hard-earned money into a company, hoping that the company performs and gives you back that money plus interest or return on that particular money. So you really have to understand that particular business. You have to understand how they make money, if they are going to make money. Like, I think it's a very crucial part of stock investing that a lot of people don't talk about. It's very easy to just say, oh, this company, go and buy it or not. Even when it comes to the volatility in the stock price of companies, like I always say, stock investing is for the long term. So imagine your company, you buy it and suddenly the price drops by half. The price, let's say, let me just use MTN as an example. You buy it as 4 Ghana cedis, and within a few weeks it goes to 2 Ghana cedis. Charlie Wakuma, you might want to sell that particular stock immediately. So if you don't really understand the business, you will really just be focusing on price, and Charlie is a bad strategy when it comes to stock investing. So I always tell people to do your research. I'm planning to do a deeper analysis where I'll take you guys through everything I do step by step in terms of my research, my DCF models, my financial models, my valuations, almost everything that I do. So that's a video I'm planning on doing. But in today's one, I'm just giving a brief one, something that, let's say you just come across a company and you just want to really understand it. You want to see if it's a company that is even worth your time to try and put money into. Is it a company you want to even put in your watch list? So this is more of a light analysis, but as a beginner, it's something that is just going to help you appreciate the company, to see if it's something you want to dive deeper to really understand the company, or if it's something really worth investing into. So we have a lot to unpack today. Let's get into the video. So I have an Excel sheet here, and today the company I'm planning on analyzing is CPC, or better yet known as Cocoa Processing Company. And we have a list of some key things that I think at first glance is just great things to know about the company, and it gives you a starting point, something to know about your company, to know if you should invest in it or not. So number one here is understand the business. I always say you have to understand whatever business you want to invest in. So one way that I like to do that is by going through the websites of the company. A lot of companies have websites now. So Cocoa Processing Company Limited, based in Tema, was established in 1964 and incorporated as a limited liability company 1981. And they've listed all their products. Let me see their products. So okay, these are their chocolate bar, Kufu, chocolate chop. I've never tried any of these. Wow. Chocolate, is it what, dark grey, granite coated with chocolate pebbles. Wow, okay. I don't think I've tried any of these. Choco Delight, okay. Drinking, okay. So they make royal natural cocoa powder. So I've been seeing this. All right. So basically they make semi-finished goods. That's what I'm seeing here. So they use cocoa to make semi-finished goods or products. Cocoa liquor, is that like an alcohol? Contains no alcohol. It is made by grinding the nib or meat of cocoa beans. I don't know what that means, but cocoa butter, cocoa cake. Okay, yeah. So I don't want to make this video long, so I'm not really going to read all of these, but I think you guys really understand what I'm trying to say. you can want this one simple way to understand the business. Just go onto their website, see what they do. You can, if they have social media pages, which right now a lot of companies do have, you can go on there as well. So this is a good way to really understand what the business does or how they make money. So right here they say the company comprises of 3 factories, 2 cocoa factory and a confectionery factory, and their main business is processing raw cocoa beans into semi-finished products. And that's all the products that we went through. So I can take this right here from the website. I can understand that their main business focus is to process raw cocoa beans and then use it to make semi-finished products, being chocolates. They have a wide variety of products. So now, understanding this thing, I think it gives you further insight to know, oh, is this something you are interested in or not? Maybe you don't think the cocoa market in Ghana is a good business. Maybe you think there's a lot of competition that probably you wouldn't like. So I think this is very good to just give you a snip insight into the business, know how the business is run, and definitely you can go deeper, but this is just, I'm just doing something quick. So after you understand the business, then the rest of the metrics is understanding the fundamentals of the business. So things like free cash flow revenue, are they growing, are they expanding its margins, or is it depressing? Are they growing their earnings per share? So we are going to go over all of these. These are informations you'll be able to get through the annual statements of the company. So looking at the stock analysis website, we can see cocoa processing companies trading at 0.03. It's up 50%, started off the year at 0.02 and now 0.03. Now, as much as I do appreciate this website, and I think this is out of all the websites I've seen, this one is, I think, the one I prefer. I think it does a good job, but they are privy to mistakes. So as much as these websites do help me a little, especially when I want to look at past data, I would always say that it would be a benefit if you do actually read the actual statements of the company. For instance, if you take a CPC, they just released their, is it Q3 or Q2? Their quarterly reports ended June 2025. You can see right here, we have their statements here. So I think it's always great to go through the actual statements of the business, because that's where you get the full information. As good as all these other websites are, sometimes they are privy to mistakes. So if you do have the opportunity, just try and go through the actual statements of the business. You get even deep information that these websites won't provide. But and then for the purposes of this video, and just to make it quick, let's just use the website. Looking at revenue, we can see right here from 2020 the company had a massive jump in revenue from 13 million to 41 million. 2022 to improved to 43 million, but since then the revenue has just been declining, went to 32, 31, and trailing 12 months 25 million. So we can see the downtrend when it comes to the revenue. Even looking at free cash flow right here is a similar trend. They have a massive negative free cash flow, so basically they have no actual cash left over to reinvest back to shareholders in the form of dividends, share buyback, or reinvestments back into the business. The company is not generating cash. It was -3 in 2021. It was good, they made some positive free cash flow, but since then negative. This year, let's compare to last year, but there's no signs that the business is likely to start making positive free cash flow anytime soon. So for this, I can't take it. They don't have growing free cash flow, or revenue is actually declining, and in terms of even free cash flow, it is negative. Looking at their margins, you could say that it's expanding, but this is a negative expansion, no matter. -22 to now -12. So it has improved since 2020, but it's still very, very bad, having a gross margin of -12. Basically, your cost of sales is way more than what you are actually bringing in terms of revenue. Operating margin the same, net. So basically, it shows that the company, out of the amount of revenue they are able to generate, at the end their expenditures are way more than the amount of revenue they are able to make. So margins is a no-no. Earnings per share growth forecast year on year. So basically, the earnings per share, how much the company is earning per one share that you own for the company. So if you're a shareholder of the company, you own one share of the company, how much is the company earning you for that particular share? And I don't even have to go through the data. It will be negative numbers because they are not even making profit. So that will also be a no take. Up next, we look at the strong cash on hand and efficient capex. So like I said, businesses, as much as we would want them to be investing in all these, we want them to make smart investments. So that's where efficient capex comes in. I just don't want my business to be spending outrageous money for outrageous reasons. I want to see them spend, if they are going to spend capex, which is capital expenditure, they are going to build factories, they are going to do some sort of operations or spending that would lead to shareholder return. I want to see it being beneficiary to me, but I don't want to just see stupid capital expenditures that would not bring back benefit to me. And also strong cash on hand. You have to have that in case, especially if you have debt, a lot of debt. You should have some strong cash on hand. Even if you don't have debt, it's good because things can happen. So a business that always has some strong cash on hand, it's a business that is resilient, is sound. It can go through struggles and still be able to maneuver through it because there's a lot of money on their hand for them to use for whatever purposes or issues that pops up. So that's always good to have a business that have strong cash on hands. Sometimes depending on the type of business, you want them to see that money being invested. So let's say if the business is not really growing in terms of its revenues or whatever, like there's not really a lot of growth, but they have a strong cash just there, just like that, then maybe that would be a red flag. But then if the business is growing, everything, and they still have very low debts and strong cash, very, very good to see. So looking at capital expenditure right here, we can see I wouldn't really say they are doing anything outrageous, but the thing is, regardless of all this spending, it might not be outrageous. Yeah, we can see here in 12 months, they've made about 1 million in capex, but you're not seeing any return. That's the issue. So I wouldn't really say it's something outrageous, but there's no return. So that's what makes it outrageous. It doesn't matter if you spend only 10 cedis or 1,000 Ghana cedis. If I'm not seeing any return on those money, it's still outrageous. And looking at their cash on hand, I was coming to give them some mark. I was like, okay, they have about right now 1 million Ghana cedis. But I just looked at their total debt and they have 38 million in debt. I mean, it has reduced over the years, okay, but still, compared to the cash, hey, you won't kill me. If I come to buy the business, I come to buy a liability, no. So in terms of strong cash on hand and efficient capex, I can't give it to them. Yeah, Charlie, debt, 38 million in debt. Like, you literally 1 million won't do anything. The capex too as well. Yes, you could say it's efficient, but there's no return. I'm not seeing anything in terms of return towards the business. Up next, we have you're comparing the assets over the liability. So an ideal situation is if you have a company whose assets is double that of its liability. Now, like I wrote, this is the ideal situation, but usually it's not in every situation that you're going to get that. Sometimes you get it just a little, but what I do expect is the assets should be more than the liabilities. Like the one they are conk. The company should have more assets compared to the liabilities. I don't want to have liabilities being more than assets. So you can see even the total assets of the company has been declining, which is not a good sign. Right now, 126 million. Let's look at the total liability. Wahali. And this is going up from 2020, it was 118 and now 134. So I can't even give this to them because liabilities is higher than that of the assets, which to me is a big red flag. A big red flag. That means you, the shareholder, not the cow. Shareholder equity, that's the actual part of the business that the shareholders own. Yet the car minus it. They say if they close the business and they you are only liable to the amount of money you invested, though, but then Jolly, what the car. So up next for number 7 and number 8, I want to add everything together, which is paying down debt or low debt. And number 8 is low debt to equity ratio and quick ratio. Now, like from what we've already seen, the company does not have low debt. If it sells all its assets, it won't be able to pay its debt. So for this, it does not pass. Low debt to equity ratio basically is the ratio that measures how much debt you have compared to your equity, and that is also negative because the company's equity is literally negative as well. Quick ratio, it measures how fast you can use your short-term liquidity, which is like things like your cash on hand. We want to see how much of it can cover your upcoming financial obligations. So within a year, the amount of financial debts that you have to pay, those things, no, can your short-term liquidity take care of it? And usually a low number will indicate that the likelihood of you being able to cover those debts is very, very low. So you want to have a high number, which will mean that your short-term liquidity can cover all your financial obligations, if that makes sense. And looking at the quick ratio right here, we can see 0.3, 0.8, 0.6, 0.4, right now 0.05. So very, very low, very, very, very low, indicating that the likelihood of you being able to pay your financial obligation is close to non-existent. So far, not looking good. But now let's go to the relative analysis. We want to look at the price of the company. Is it overvalued or undervalued based on these 3 metrics: the historic price to book, the price to sales, and price to earnings. Now, if you don't understand all of these, I'll explain it. But one thing that I would say is that I think it's very easy right now. Social media, Google, ChatGPT, all of these tools are available. So if there are things out there that you don't understand, it's so easy to just quickly search on it. You try and wrap your brains around it, and I'm sure you get it so easily. Because right now, I would say it's now like almost 5 years since I took investing very seriously, and once in a while I still come across something that is very new to me. I don't really understand, so I have to search about it. If there are people knowledgeable on it, I just ask them. So I think that's one way you can really help yourself when it comes to researching and doing analysis in investing. There is no PE ratio because the company is not earning. There is no earnings that the company is making. The company does not make net income, so there's no way to see the PE ratio since the company is not actually earning money for you as the shareholder. In terms of PB, it is negative. So finally, we'll end off with growing or consistent dividends. Then we have return on invested capital or return on equity. And we want to see it equal or greater than the average or the market average. And lastly, durable or competitive moat. So this would come with understanding the business. And a moat is like maybe in terms of the dominance in its space. Like, so for example, with MTN, like this, we can see MTN as a durable or a competitive moat because it has strong brand loyalty. There's a lot of people who know about MTN, who use MTN. When it comes to the telecom space, it has the dominant market share of the telecom and even the mobile money space. So that's what you would call a competitive moat. I don't really know the chocolate business like that, so I don't really know if it has a competitive moat or not. So I don't even know if I'll give it to it. Looking at the return on equity and return on capital, invested capital, we can see here negatives. negative, negative. So all of these metrics are negative. And when it comes to dividends, the company does not even make money, so there's no money to even give shareholders as dividends. So looking at all these metrics, the only thing that we ticked off here was understanding the business. The rest of these metrics here, the company failed everything. It failed everything. It's not growing free cash flow revenue. Margins are not expanding. Earnings per share, there's no growth. You can't even forecast for it. No strong cash on hand or efficient capex. Has liabilities which is more than the assets. It's not paying down debt, and the debt in itself is not even going down. They have a massive debt. All of these metrics bad. Does not have PE ratio, price to sales and price to book, all showing negative, meaning compared to what if you had bought a share in this particular business, you would basically be losing money, or you are entitled to losses by just purchasing that particular business. It's not paying dividends, return on equity, return on capital invested, and the competitive or doable both. All of these metrics are things I'm not going to take here. So right from this analysis, just this slight analysis, I can see that CPC is a company I'm not willing to invest anytime soon. I don't have to do a DCF model. I don't have to be the most brilliant person in school to understand that this business is bad. This business is not good until something changes. Hopefully in the future, I can't tell. I'm not even going to do any analysis to see, if this is a business Ghanaians like over the next 5 to 10 to 20 year period. Is this business still going to survive, or is there something going to be another competition? No, you don't even have to look at all these things. Just seeing this slight metrics, you can see that the company, massa. If you are invested in this, actually, I cry for you. I cry for you. So I think this is just something easy, just something, I wouldn't really say a deep analysis, but at least it gets the job done for you to really something on the lighter side, for you to get a grasp of the business, to know if you want to invest in it or not. So if you are interested in this, let me know. I don't know, maybe I'll link it down in the comments for you guys if you want it or not. Thank you so much for watching. Comment down below what you think about this. Is this analysis something you would like to try or not? Do you have a different form of analysis? I would love to know. And if you're interested in the deeper step-by-step guide on how I do my research analysis, let me know. I'm planning on doing that video, probably not now because I don't think I have the time for it, but yeah, I'll probably do that as well. Thank you so much. Make sure to subscribe, like, share the video as well. I'll really appreciate it. Until we meet again, have a wonderful and blessed rest of your day. Not buying CPC, because if you do, wow, what's